What if I told you that your home loan was already paid for the moment you signed the paperwork, and the bank just flipped the script to make you believe that you owe them for what, 30 years? This is the truth about mortgages and how discharge ties into them. So before we dive into this video, this is not legal advice. This is not financial advice. Remember to do your due diligence. Okay? Everything we talk about on this channel requires complete understanding before actually taking action. This is why I tell you to do your due diligence. Number two, if you're brand new, hit the subscribe button, hit the like button, tap in on a daily basis because we do post daily content Monday through Friday. Happy Thursday to you. You dig what I'm saying? Thank you guys for watching this video once again. Now, this is a deep dive into mortgages. Now, I've done a couple of videos on mortgages, probably done a deeper dive, but this right here is going to be more of a big picture, okay? More of like streamlining the process and kind of compiling it all in one video as short and concise as I can. Okay. Now, y'all know me, it's hard for me to be short and concise. So I'm gonna try my best to do that. But my overall goal is to really just break down the big pictures on how to be able to discharge mortgages. Okay. So make sure you stick around all the way to the end so that you can get this game. Now, the first thing I want to talk about is how mortgages really work. So when you sit down at the closing table, here's what actually happens. You sign a promissory note. Now, that note isn't just paperwork. It's actually a negotiable instrument under UCC 3-104. So it carries real monetary value. All right. I don't care what anybody says. When you look at UCC 3-104, it says that a negotiable instrument is an unconditional promise to pay. So understanding that a mortgage note or a promise or a loan agreement for a mortgage is actually a security instrument, which is a financial instrument to the bank that they can use as an asset. So understanding that, you've actually exchanged real value with them, and what you think you just exchanged was just the promise, not knowing that the promise has real value, okay? The bank then takes that signed note and deposit it as an asset on their books. So your signature literally created the value. Okay. Under the UCC, it says that your signature actually completes an obligation. There is no obligation without your signature. So you are the one that actually created the obligation. The obligation is what has value. All right. And then they use that deposited asset. The bank then creates credit entries and cycles it back to you as what they call a loan. So if you pull out a $300,000 mortgage, they record the asset on their books. And then on the mirror side, they record a liability saying that they lost $300,000. But it was after they acquired the $300,000 from the promissory note. Okay. So what they're doing is they're playing an accounting trick to where one point they're giving you they are acquiring $300,000, but then after the $300,000 is acquired, they then create a separate entry, making it seem like they lost the money. Okay, so the deception is really in the framing, okay? Because they never loaned you pre-existing money. They loaned you money that was just created. So technically, they never loaned you money. Okay, they use your note to generate the credit that funded the deal. Now, someone may look at that and say, well, what would be the point of them asking for getting the $300,000 originally and then creating a mirror liability of negative $300,000? Wouldn't that like balance out the books? Yes, it would balance out the books. Okay, so then the question is, well, what is their real profit? The profit doesn't just come from them balancing out the books using accounting tricks. It comes from the fact that they securitize it, they make money off of it, and then also at the same time, they're able to fractionalize it. So even though they are getting $100,000, $300,000 from your loan or from your notes, because of modern banking, they're able to multiply that $300,000 9 times. Okay, so they are creating a mirror liability and making it seem like, okay, technically they should be at zero balance when they loan out the money that they created based off of your signature, but they actually get more. Okay, and that's what they don't talk about. So the point is, you funded your own home with your signature, but the bank flips the script and makes it seem like you owe them for the next 30 years. The reality is that's not the case. They just created a mirror liability of the money that you funded them. Okay? This is why the mortgage contract is so dangerous, because you walk in as the creditor, but walk out believing that you owe them, that you are the debtor. The whole business model depends on you never really realizing the note itself was the money. So when people say that mortgages are prepaid, it's not off a flag, okay? Because what you sign is a financial document that they can then monetize. That's the value, okay? It's not that, okay, yes, it's not nothing. That's what's actually happening. Okay. If you think it's like some magical number that happens, or they're giving them money or whatever the case may be because you signed it, or you have some supernatural power that gives you the ability to get whatever you want in life, that's not that. You know what I mean? It's kind of like that. But the real world example is the fact that they are creating a mirror liability of money that you funded, that you authorized them to be able to acquire. Okay, so here's what I talk about, the securitization trick. Okay, after you sign, most mortgages don't just sit in the local bank. So you think that they are just holding the money. They are not holding the money. Okay, they are then bundled, securitized, or even sold on Wall Street as a mortgage-backed security. So this is on top of them being able to fractionalize it. This is on top of the original entry that they got. They then are able to multiply it and even sell it to Wall Street, okay? This means that your note has already been monetized, sometimes multiple times before you even make your first payment. I mean, it only takes 30 days for them to do this stuff. As soon as they get the note, they get straight to the money, okay? So the bank got paid up front, but over the next 30 years, you still have to pay the mortgage. And this is what brings up a disagreement between us and the creditor. This is where we start to have our disconnect, no meeting of the minds. Because how are you going to make more money that I'm going to end up paying over the next 30 years? And I don't get a piece of it. I don't get a cut of it. And I'm the one who funded the transaction. That's the problem. All right. This separation of the note and the mortgage is why there are cases like Carpenter versus Logan that rule that the mortgage follows the note. Okay. Without the original note, any type of foreclosure claims, would be risky for them. Okay. Because again, if they sold the note, then the mortgage goes with it. If anything, you should be paying the person that they sold the mortgage to if that's something that you owe. You shouldn't be paying them back because they're not the legal holder in due course. And under UCC 3-305, you can assert yourself against anybody who makes claims that they're a legal holder in due course and cannot prove it. Okay? So the securitization, just to sum that up, after you sign up for your loan, you essentially have, so when we talk about the illusion of monthly payments, all right, had to take a quick pause because I had some work to do, but we back into it. Most homeowners believe that monthly payments are steadily buying them ownership, but the reality is the system is structured to keep you performing. So they will bring things up like refinancing and whatever the case may be, because any type of program or product like that is not really to help you. Yes, it may give you a lower percentage and you can be strategic about these things, but it's really to restart you. All right. It's really to keep you in this perpetual cycle of debt. Okay. So for the first 10 to 15 years of a standard 30-year mortgage, the bulk of your payment go towards the interest and the servicing fees, and very little touches the principal. We already know this. Okay. And a lot of times you are told to spend a little bit more so that you're able to hit the principal. But this isn't an accident. It's designed to maximize the bank's profit up front while you carry the illusion of building equity. Why would I need to build equity into something that already should have the equity? You know what I mean? Like if I already paid for it, why can't I just sell it for what I already paid for it? Why do I have to build equity? The equity should just grow based off of the location or whatever the case may be, not for me paying interest. All right. Like some of these things that we do, it doesn't even make sense. It doesn't, but we do it anyways. And this is why I tell everyone to question the system. Okay? So every monthly statement that you get gets a remittance coupon on it. Okay? Most people tear it off and send a check, but that coupon itself is actually a pre-structured negotiable instrument, and it's evidence that the transaction is intended to be settled by accounting entries, not just by cash. So when we're having this conversation about negotiable instruments, when we're having this conversation about debt, when we're having this conversation about financial instruments, you literally get a financial instrument in your mailbox every single month to set off your debt and balance out the accounting. You know what I mean? And we look at that and never truly question it, never truly said, okay, well, what is this that we're being sent? Okay? And then on top of that, your mortgage is being securitized or has been. Your payments aren't even going to the original lender, and they are routed through a loan servicer who just manages the account while the investors already got paid when your note was sold as a security. So the monthly grind isn't about you paying off legitimate debt. It's about keeping you locked into performance and ensuring that the system milks you for decades. This is why mortgages are a scam. This is why we are even having a conversation about discharging mortgage debt, because we don't want to be in a perpetual cycle of paying mortgage for the rest of our life. Now, I'm not at all saying that you shouldn't pay your mortgage, okay? Because if you are okay with paying a mortgage that was already paid for, and you have the energy and time, you're not expending a lot of time doing it just so you don't have to sit and, it sounds crazy, so they don't harass you about paying the debt, then just pay it. You know what I mean? Going down this road is actually not going to be easier than you think. You know what I mean? You think it's going to be easier to discharge debt, communicate with debt collectors. It's not. I'll keep it up front with you. It's much easier to pay your debt, you know? It's much easier. And the only reason I can see that is easier now is because I do have the option of discharging debt, okay? Because I found a way to expend my energy, not just on money, but to expend my energy in other ways that allows money to be attracted to me. That way, if there are debts to be paid, it doesn't even amount to the energy that I expended, okay? Sometimes the solution is not always about discharging your debt, but understanding that can benefit you and allow you to see how easy it is to actually just pay it, okay? But it's more about being able to look outside the box, more about being able to see what's actually happening behind the scenes so you can decide what you decide to do, what choice you make. Am I going to pay it, or am I going to attempt to discharge it? Is this something that's something that I do not want to pay, do not want to put my energy towards? Boom, I'll just discharge it. But you have to know how to do it. It's a skill set that requires a high level of attention and intention, okay? Now let's talk about why foreclosures happen. Foreclosures is the weapon that banks use to enforce the illusion of debt, even if it's already been paid, okay? So when you default by missing payments, the bank claims the right to seize your property, and it's literally because you agreed that if you stop making payments, then they can seize your property. That's why they can do that. I mean, it seems like I just said it, but until you can shift that agreement to be unenforceable, yes, they can seize your property, and they have legal grounds to do it, okay? Here's the truth. They've already monetized your note at closing. They likely securitized it, sold it to investors, or pledged it as collateral, and they have already been compensated, often multiple times, okay? Foreclosure is about recovering a loss and more about contract enforcement. And when you agreed to be the debtor, you also agreed for them to take the collateral when you stop performing. Okay? Legally under UCC Article 9 for secure transaction, a party must prove they hold the note in order to enforce foreclosure. That's why many homeowners have been beaten in foreclosure by demanding the original wet ink signature. Okay? Most people beat foreclosure because when they challenge the mortgage company to provide these documents, they cannot provide them, and they lost their legal grounds to even foreclose. Okay? That's the key. To stop a foreclosure, challenge them and flip the burden onto them to provide information that would prove or give them legal standing to collect or foreclose on a particular property. Because if the note has been sold, transferred through MERS, or securitized, the bank often can't produce it, and this is the weak point in their claim. Unless you are the legal holder in due course, you cannot enforce the note that said, I agree for you to seize my property if I stop paying for the debt, okay? But most homeowners don't know their rights. They don't know that they can challenge them. They don't know that they can demand certain documentation. And they just accept foreclosure as if the bank truly lost money. But in reality, a repossession of homes is just another way that the system maintains control and keeps that illusion alive that you have to pay debt in order to survive. Okay? So foreclosure is not an actual loss. So unless they actually lost something, technically they can't seize it. But if you contract and you agree for them to seize it when you stop paying, then they can, unless you nullify that original contract, which is why you asked for it. Okay? These are things in the Constitution that you can do, but the things that you can't do is what people talk about with, these mystical formats of discharging debt, form, whatever the case may be. You put this type of gold check. I'm not saying none of these things don't work, but it's hard to find the legal basis behind it. When there are things already simple enough that you can use to challenge it that have actual legal basis. Like challenging a company and saying, hey, I demand you to provide me the accounting based off of this account that I'm attached to. You have a right to do that under UCC Article 9. If you create a negotiable instrument and you're using it to pay for a particular product or service, that is in the UCC under UCC 3-104. And unless they debunk that or find the law that combats that, you really have no legal claim. Now, if they do give you a law, you should be able to read that law, fully understand it, and really tell them, okay, look, no, this law has nothing to do with what I am talking about, So let's just talk about the discharge path, big picture. Just like I've done with every video this week, we're going to break down step by step how to be able to discharge a mortgage, okay? So number one, the first step is the understanding. This is why we go over it. Understanding what is happening behind the scenes. Understand that they can securitize it, that they get paid through insurance, that they get paid in multiple ways, not only through that, but through fractionalizing, okay? These are the reasons why you can discharge a mortgage, okay? Not because you can send a coupon or what. Yes, you can do all of these things, but it's just as simple as the fact that they could be participating in unjust enrichment. They could just be violating contract law, and that right there alone can get you to discharge a mortgage. But if you don't know how to challenge them on that, if you don't know how to do that or know what is truly happening behind the scenes, you won't even have the heart to challenge them. Okay? Some of you guys are stuck in belief mode, but I need you to go into knowing mode. All right? Belief means that there's a doubt. Knowing means that there is no doubt. So until you get to a space where you know, do not try this. All right? Now, this is not legal advice, but I'm about to break it down. This is what I would do. First things first, I would challenge them using debt validation. There's no point in you challenging a company or sending a negotiable instrument to pay a debt unless they have validated it. So you start off with debt validation under 15 U.S.C. 1692G. Okay? You have a right to challenge debt. Okay? So under the FDCP, anytime a debt collector comes after you, I don't care who it is, a mortgage, an auto loan, a credit card, you want to send them a debt validation letter. Okay? And until they validate a debt, you don't need to send any type of negotiable instrument. But let's just say they do, or they somehow trick you into thinking that they validate the debt. You then want to dive into using coupon remittance or structuring your own negotiable instrument. You want to endorse and return the remittance slip to instruct the set-off. Also including notice of tender, okay? If you're going to send them a coupon, you want to make sure to send them a notice with it, laying out exactly what it is, what you are trying to do, the legal basis behind what you are doing, and what you need them to do in response to this, and what will happen if they do not respond to it. This is what your cover letter should say, along with your coupon remittance or any negotiable instrument that you send, promissory note, private bond, whatever the case may be. On top of that, you can then look for 1099 filings and use that against them, because if they file the 1099 on your account, on your mortgage, that means it's charged off. That means it has been discharged. If it has been discharged, that means that they have already settled the account. If the account is already settled, then they cannot double recover. They cannot make more money off of something that's already been settled. So boom, 1099. You can file a form 4506T with the IRS and literally get all the documentation based off of your SSN. Any 1099s or whatever the case may be that was filed on your behalf, if you file a form 4506T, then you'll be able to get those transcripts. But if you see that there's a transcript and you see that it's charged off, that brings up the case of it's being discharged, and you can use that with your claim. Okay. The second thing you can do is, and this is if you are running through a trust, you can do a UCC filing and give public notice of your security interest in that property that they will attempt to foreclose on. Now, this is not something that's going to completely take you out of the game, but it does give you proper positioning for negotiation. Because if you claim that you have security interest, now they have to prove that they have some level of security interest, okay, over you. The next thing, you want to take them through conditional acceptance. You want to accept the obligation only if they prove that they loaned their own funds. If they fail to do that, then they have dishonored you. That is what conditional acceptance is. I will pay, or I will agree if you can prove X, Y, and Z. You are not dishonoring. You are moving with honor and expecting them to move with good faith and honor. Because again, if you want to get paid, just prove the stuff that you need to prove to me. It doesn't cost you nothing to do that. And then lastly, make sure you tender in honor. Understand UCC 3-603. It's a lawful method to discharge obligations without the traditional payment, because if you send a negotiable instrument or a note or something that you are entitled to enforce and they refuse it, then there is discharge under the UCC. So again, that's how you break it down, step by step. If you need to go back and watch it, go back and watch it. But here's the big picture. Mortgages are not banks giving you money. They are just funding you your own house with your signature, okay? Banks will flip the narrative, securitize the asset, and then make you think that you owe them for the next 30 years. But the reality is, discharge is not about getting out of paying. It's about using a built-in remedy that exists because the system runs on credit, not cash. All right, so the next time you look at your mortgage balance, remember the bank has already made the whole amount the moment you signed, okay? The rest is just performance. Discharge is the remedy they never teach you, because if you knew, that 30-year debt cycle would collapse. So if you want to break down step by step of the discharging process when it comes to mortgages, you want the letters, the templates, all the information, the resources in regards to discharging mortgage, down below. Tap into my school community, 7 days for free. Okay. On top of that, if you want to work with me one-on-one, you want to book a one-on-one session with me directly to maybe talk about your mortgage, or maybe even talk about the coupon remittance or debt discharge, go ahead and tap into that one-on-one application down below. Again, it's a private coaching experience, so not everybody can become a part of that. Other than that, hit the like button, hit the subscribe button. I post free content on here Monday through Friday. Thank you guys for watching the video. I love you guys, and I'll see you in the next one. This video is sponsored by the Fund Yourself Academy. My step-by-step system designed to help you fix your credit, get funding, and build real financial freedom from scratch. If you're tired of feeling stuck, overwhelmed, or just ready to stop living paycheck to paycheck, this is where it changes. Inside the Academy, I break down everything from consumer law secrets that they don't teach in school, to how to remove negative items and boost your score, get access to business funding, and start building multiple income streams online. Whether you're just starting out or ready to level up your game and get the bag, this is your playbook. We've got tools, templates, dispute letters, mentorship calls, private community access, and an exact roadmap I use to leave my 9-to-5 and create time freedom. But only for a limited time. You can get access to the Fund Yourself Academy on a free trial basis for the next 7 days. And then after that, you pay less than $1 a day at $27 a month, if you like it. No fluff, just facts and just freedom. Go to the fundyourselfacademy.com or hit the link in the description to join now, because nobody's coming to save you, but you can fund yourself.